Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio, we have Calvin Tse. He's the head of macro strategy Americas at BNP Paribas, with his thoughts on if we will get a recession in 2023 or not. It is great to have you with us, Calvin. Welcome to Trade Talks.
Thanks for having me, Jill.
Do you expect a recession in 2023? And if so, how severe do you expect it to be? And does that impact the recovery for 2024?
We are expecting a recession in 2023. It's our base case scenario. We're expecting the recession to hit in Q2 of next year, but we expect it to be a rather shallow recession, somewhere around a 1% decline in real GDP. And the reason for that is we do think that the Fed has done enough to engineer a material slowdown in the economy, but because we still have a relatively strong labor market and a strong US consumer, we believe that the recession is going to be that bad. To answer your last part of the question about the recovery, we think the recovery is going to be rather slow, however, because we do think inflation is going to be rather persistent. And because of that persistent inflation, the Fed is probably going to be slower to come save the day, come to the rescue, and to cut rates.
So not as bad of a recession, but it's going to be longer in duration is what you're expecting.
That's right.
Is the market pricing in a recession as it relates to equities?
The markets are not pricing in a recession, in our view. If you look at 1 year ahead earnings forecasts, the markets are looking for approximately 6.5% earnings growth next year, which to us looks way too high if we're actually seeing a recession. So if we plug into our own models, we think the models are telling us now that the markets are offside by approximately 8% for 2023 and 10% for 2024. So because of that, as a recession hits, as earning expectations get scaled back, our view is that we still have quite significant downside to come in the U.S. equity market.
So you don't think analysts have taken down their estimates or their expectations enough going into 2023 once we start getting, Q4 and Q1 earnings starting to come out?
That's exactly that. We think the Q4 and Q1 earnings are going to be a major catalyst for the equity downside that we're expecting for next year.
What about the U.S. dollar?
The dollar is the primary safe haven currency of the world. As we know, when we see a recession, we typically have a flight to safety. And when we think about safe assets in the world, it's really AAA rated sovereigns that protect people. But if we think about where you could buy AAA rated sovereigns, Japan has essentially bought most of the JGB market through the BOJ. The ECB has largely bought most of the Bund market. So if investors truly want a safe asset to protect them in a period of economic contraction, it's really buying treasuries. That is going to be the asset that you can buy. So when you're buying treasuries as a foreign investor, you're going to have to be buying the dollar with it as well. And therefore, because of that, we think that the dollar remains stronger for longer.
Right, and then of course that's going to impact equities, especially your international conglomerates where FX is such a big part of their balance sheet and it impacts their earnings.
For sure. So we think that these macro forces will combine together: a stronger dollar plus interest rates that are held at higher levels for a prolonged period of time, plus economic recession. The combination of these factors, we think, drives potentially another 10 to 20% downside in equities next year.
All right. Calvin, appreciate the insight. Thanks for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.